I'm about to show you data that will completely change the way you look at investing. 90% of day traders lose their money within their first year, versus long-term investors, they usually see an average return of 10% per annum. That's not my personal opinion. This is hard, cold data that comes from multiple sources. And by the end of this video, you will understand why this is the case and what is the real route to building wealth. These days on Instagram, on social media, TikTok, you see those people that are trying to sell you this day trader lifestyle that, you should quit your job, quit the UK, move to Dubai, not pay any tax and day trade, and you're going to be instantly rich. So if you've ever wondered if you should be day trading or investing, please watch this video because I will settle it once and for all. Here's what I discovered after diving deep into the research around day trading and investing. Most people think that day trading and investing are the same thing, it's just different time scales. But in reality, they are very two different methods of putting your money into work and vastly different chances of you winning. Let's start with the data, or the main piece of research that shocked me the most. A comprehensive study from the University of California analyzing 66,000 trading accounts found that 80% of day traders lose money over a 12-month period. But here's what's even more insane. Of the 20% of those who actually made money, most of them did not even make a minimum wage when you factor in the time invested. It sounds like a pretty bad deal, doesn't it? Another study from Brazil that analyzed 20,000 day traders in 300 days found that only 3% of them made the minimum wage. Only 3%. And it's study after study that shows the same pattern. For instance, the American financial regulator, which is called the FINRA, they found that 4 out of 5 day traders lose money. And there's another study from the Taiwanese stock exchange that showed the same results across different cultures in different markets. Meanwhile, historical data shows that an investor who bought and held a diversified index fund over a 10-year period made an annual return of 10% per annum. And that investor who was holding an, let's say, S&P 500 index fund, that specific index fund has never had a negative 20-year period in its entire history. Okay, so now you have to start asking yourself why these two different market approaches produce such a vastly different result. To understand why trading fails, you need to understand what trading actually is. Trading is an attempt to profit from short-term market movements in your stocks and shares or other listed securities. And usually you're looking at periods of minutes, hours, days, weeks, sometimes even months. And traders use something that is called technical analysis, which means that they're trying to predict the future price of their investments based on their past price performance. They're essentially betting on which direction the prices will move in the short term. But here is what most people don't realize. It is very difficult to predict the future. And if you're a day trader, you're not just competing with other day human traders, but you're competing with algorithms that are executing lots of trades in a minute, that have direct access to the markets, and they can move swiftly when the market falls or when the market appreciates. And how accurate is the technical analysis? Because in the financial markets, there's something that is called the efficient market hypothesis. It is supported by decades of research, and it basically suggests that all the information is already reflected in the current prices that you see on the stock market. So then it sounds like it's almost impossible for you to predict the future price. If you want to accurately predict the future price of your investment, you would have to have some information that nobody in the market has at the moment. It sounds like a fairy tale a bit, doesn't it? So you can clearly see that there's been a lot of research that suggests that trading is something that potentially an average Joe shouldn't be getting themselves into, right? Why do people still feel attracted to day trading? On social media and everywhere, people are still trying to do that, even though there is an overwhelming amount of research that this will lose you money. Well, it is all down to human psychology. And research by a lot of behavioral economists suggests that we are wired to make terrible short-term financial decisions. It is part of being human. There are 3 main things in our psychological setup. Number 1 is the overconfidence bias, which makes us think that we can predict the unpredictable events. It is, of course, not true. Number two is the loss aversion, which makes us hold on to losing positions for too long and sell our performing positions too quickly. And number three is the confirmation bias, which makes us see patterns that are not really there. So when you're investing, whatever you're putting your money somewhere, be aware what your brain is doing to you. Now, let's look at investing, and here where things are different. Investing is really buying assets with the intention of holding them for years or decades when you're hoping that you would profit from the business growth and the compounding effect of that investment. Here's what data shows about long-term investing. Since 1926, the index fund, the most popular one called S&P 500, returned an average of 10% per annum. Let me show you the math that really changed everything for me. If you decide to invest £500 per month, every month, at an average return of 10% per year through a diversified index fund, in year 10, you will have £102,000. In year 20, you will have £379,000. And in year 30, so, when you're probably about to retire, you will have £1.13 million. And this calculation, or this growth that you can see, benefits from something that is called dollar cost averaging, which is known to reduce volatility and improve your long-term returns. There are also different tax advantages. For instance, in the United States, your short-term capital gains, such as those from short-term trading, day trading, they are taxed as ordinary income. So in many states, you can pay over 30% of tax on the actual profit from day-to-day trading. But long-term capital gains are usually taxed differently. They're taxed at a lower rate, which ensures that you're keeping most of the money or more of the money that you're actually making investing in the long term. And here is what I find most compelling about long-term investing. In order to do it long-term, you only need to invest probably 1 or 2 hours per week or even per month doing this. Versus if you're doing short-term day trading, you usually need to day trade for 8 to 12 hours every single day. Time is a luxury, so better use it wisely. The psychological differences between day trading and investing are really fascinating, and it really tells you something about how your brain works. Trading is believed to activate the same neurological patterns as gambling. The intermittent reinforcement rule, that means sometimes you win, sometimes you lose, creates what researchers call addiction-like behaviors. But here is what's super interesting. The most successful investors, according to Fidelity Research, they either forgot about their investments or they are dead. This basically means that the less people played or interfered in their investments, the more successful they were. And who is the most famous long-term investor other than Warren Buffett? Well, he's investing long-term. He's not trying to profit off of short-term market movements, but he's buying established businesses at fair prices, hoping that he will profit from the long-term capital appreciation and the dividend income. He doesn't panic sell, he buys and he holds it over long-term. Studies consistently show that time in the market beats timing in the market. Missing just the 10 best days in the stock market in the last 20 years reduces your average return by 50%. Okay, so based on all this research, here is the evidence-based strategy for you to build wealth. Step number 1, build your emergency fund first. Financial advisors and research always recommend between 3 to 6 months of your living expenses saved, ideally in a high-yield interest saving account, so that you can fund your unforeseeable expenses with a peace of mind. Step 2, choose a low-cost investment platform. There's different investment platforms that you can choose from in the UK or in the US. Some of it is Vanguard, Fidelity, Trading 212. You're trying to look for an investment platform that is simple and has a simple, low-cost structure so that you can maximize your return over the long run. Step 3, invest in diversified index funds. So again, there is an overwhelming evidence to suggest that the actively managed funds, which are the ones where there is an investment manager trying to pick investments for you, 80 to 90% of them tend to underperform the index funds that are passive, that are not actively managed. Step 4, automate your investments. Studies show that dollar cost averaging reduces your investment volatility and improves your long-term returns. So you need to ensure, and it's a psychological trick as well, that you invest every month, the money goes straight from your paycheck to your investments, and ideally you just forget about your investments. Step number 5, minimize your tax liability. Whether you're in the US or the UK, try to use tax wrappers or investment accounts that provide you some tax benefits, like ISAs in the UK, where you can put £20,000 every year into an ISA, and any returns from that £20,000 in every single year will be tax-free. Look, I didn't make any of this up. Trading is statistically likely to lose you money, but long-term investing has historically been the most reliable path to long-term wealth building. If you want to dive deeper into the research that I've just talked about, then I shared all the links in the description down below. If you like this video, if this video in any way changed the way you perceive day trading or investing, please leave a comment down below. Thank you very much for watching. This is Cash with Como, and see you next time.